Happy Monday, everybody. I hope you had a great weekend. Today is October 2nd, 2023, and this is your first of Q4 Monday Market Update. Welcome to the fourth quarter, and we are in October, known to be a wild month, as the calendar goes at least, and also known to be a bear killer, where weak markets stop going down. So how's that going to work out? We're going to have to find out. September held true, but let's get to that in a few minutes. Let's recap last week's market action and bring you a preview of this coming week. First of all, last Monday, of course, was Yom Kippur, and I already reported on Monday's action, or lack thereof, in last Tuesday's market update. Simply, on light volume, the Dow was up slightly, and the S&P and the Nasdaq were both up just under 0.5%. Stocks picked up where they left off the week prior after a short break from selling on Monday, but Tuesday had stocks come for sale again and gapped lower as concerns grew about China's property market. There were a few major players arrested at the time, something, by the way, you probably heard me say was noticeably absent in the great financial crisis here in the United States. Regardless, fears that things could get worse in that sector and maybe bleed into other sectors and impact global markets, there was little other news. So the markets held on to that and the selling that came along with it. Yields up, oil up, Kashkari from the Fed giving a 60% chance at a soft landing, but a 40% chance that rates will have to go significantly higher to beat inflation. A slow bleed lower with a small short squeeze at the end of the day left markets just off the lows for the day, all three markets down about 1.5% on the day. Stocks gapped higher on the open on Wednesday as treasuries seemed to be stabilizing, but that was short-lived. As trading got underway, the positive vibe faded away. There was hawkish eco data, and on top of the stagflation feel in the air, things were not accelerating yet. Mid-morning stocks did start to accelerate to the downside as Speaker McCarthy had negative sound bites on the possible shutdown coming along. Risk came back into the credit markets with cautionary comments from Fitch and Moody's about the U.S. consumer. Oil rally did not help to calm anything. The S&P broke the next support level at 42.50 about lunchtime, then a strong 5-year Treasury auction, and that allowed for a near-term bottom to be turned in by stocks. Dip buyers came in and brought things back from the multi-month low and finished close to where they started. Dow down 0.25%, S&P just down just a hair over flat line on the positive, and the Nasdaq up 0.25%. There's a lot going on in the credit markets. Moody is now looking at a debt downgrade for the U.S. Treasury bond. We saw this from the S&P a few years ago, Fitch just a month or so ago. Government shutdown or not, we'll see what the credit agencies think of that. It's amazing that the credit agencies still move markets. Remember the AAA rated bonds that ended up being a big part of that great financial crisis? Remember that? As I tell you often, markets have short memories. Thursday had stocks opening little changed as markets were encouraged by cooler than expected CPI data, yes, from Spain and Germany, but cooling nonetheless. We've been watching this. Global eco data is pulling a lot of short-term weight in the markets. How long does this last? We'll have to see. That news was the offset to the looming government shutdown news and the UAW strike news. Jobless claims near 2023 lows, thus showing that the labor market is not cooling. Newswires were busy. Fed had Goolsbee on the tape again, talking about the Fed being at risk of overshooting if they continue to put too much emphasis on labor markets. Also, the consumer spending is cooling, consumption estimates coming down. All of this, eco data, a pullback in oil and treasuries stabilizing, allowed stocks to gather up some upside steam. And in Wall Street Journal, and a Wall Street Journal article about easing economic tensions with China, S&P was up 1% going into the afternoon. Newswires quieted and waited for Powell's speech to the teachers coming in after the close. The Dow did close up 1/3%, S&P up 0.5%, the Nasdaq up about 0.75%. At least we saw green. So stocks opened higher on Friday, looking for a solid end to September trading. Nothing notable about the economy from Powell on Thursday with the teachers. Spoiler alert, we did not finish as pretty as we started the day. On the open, things looked good. Dow about up about 0.5%, S&P up about 0.75%, and the Nasdaq up almost 1%. That was the open. PCE and core PCE, the Fed's favorites showed price increases slowing. Recall that is price increases still, even though they're slowing, but they're still going up, and that is what the markets needed to see to get started. Growth was a leader. 6 of the 7 magnificent 7 stocks were higher midday, from 1/3% on Meta to 2.25% on Tesla. Only Alphabet was lower by about 1/3%. For the month, as of midday report on Friday, 6 of the 7 were lower. NVIDIA down 11.5%, Apple down 8.75%, Amazon off 7.75%. The only one up for the month, Meta up almost 3% higher. The move up ran out of steam, or you could say that there was cold water thrown on it. Fed head Williams talked more about higher for longer. Slower growth and higher unemployment are his estimates for 2024. Comforting? Not really. So by the end of the day, Friday looked no better than September as a whole. For the day, the Dow was down 0.5%, S&P down 0.25%, and the Nasdaq eked out a gain of just under 0.25%. Regardless of all the reports and the data showing that government shutdowns don't cause too much harm, in the long term and even in the short term in some reports, the markets reacted to the tape and went into the weekend very worried. As September and Q3 came to a close, the Dow was down 3.5% on the month. Down 2.5% for Q3. S&P was down just under 5% on the month and down 3.75% for the quarter. Nasdaq was off 5.75% on the month and only 4% down on the quarter. A lot of oversold talk. Also, technicals not looking so good. So back to the push me, pull me. Like always, watch for the reports and articles. I'll report on them too, on all of the October calendar and seasonal stats coming soon. The Senate passed a last-minute spending bill Saturday that will avert the government shutdown, and not to worry, 3 hours to spare. The bill allows for 45 more days, and it was signed by Biden late Saturday night, just under the wire. So that sets up this week. Looks like the markets are set to react to that news to the positive. If they had a shutdown, recall that I told you that all of the main government reports were going to be on hold. So here we go. It's the beginning of the month, so we get all the jobs data, JOLTS, ADP, the non-farm payroll too. That's on Friday. The market should like the fact that there is no shutdown, at least for another 45 days. We'll get some PMIs for services and manufacturing and consumer credit also. Fed blackout period is over, so we have a full slate of Fed heads on the tape. Powell, Bowman, Waller, Barr, Harker, Williams, Mester, Bostic, Goolsbee, and Daly. By the way, I know that these names themselves are not so interesting to you unless you have the Fed head collector cards. The key to listing these is to remind you that pretty much every time one of them opens their mouth, the market could react. Again, a reminder, the Fed is not looking to surprise these markets, as we have seen, and they are doing all they can to keep that from happening. They are starting with the Fed heads, put ideas out there, see how the markets react, then whisper to Wall Street Journal's Tim Rose, then confirm it with the Goldman Sachs research piece. Then you're no longer surprising. So note that the long list does mean something. We have just under 2 weeks before the banks kick off earnings season, so we'll concentrate on the Fed. I'll be back on Friday with another planning video, and Monday with more market updates. Watch for some October seasonal news. Until then, have a great week.